Welcome to Startup Club. You're listening to Serial Entrepreneur Secrets Revealed. And today we're going to talk about the art of the exits, when to merge versus when to sell. Should you stay with the company? Should you go? We're going to try to figure that out. And we have an expert with us today, an M&A expert named Pierre-Alexandre Heurtebize. Pierre, well,
Hello, hello.
hello. You're coming in a little light sound. I'm jumping you right into it. Here's Michelle Van Tilburg, our moderator as well, and Mimi Ostrander, who actually writes the blogs on the website. If you haven't already checked this out, go to startup.club and have a poke around. There's a lot of great articles. We've done some great sessions on GPT over the last few weeks. Different ideas you can use AI to help your business. But today we're talking about the art of the sale, whether to merge or to sell, whether to stay on or not stay on. I've been involved with about probably 12 to 14 sales in my life, and I've also been involved with equal or even probably a few more acquisitions in my life. And I can tell you they're all different and very interesting, and every one of them has very different characteristics. So if you like this room, what I would ask you to do if you're in the audience is, or even on stage as well, if there's a button on the bottom of the room, right, the second from the left is a share on Clubhouse. And I'm going to do that right now. Share it on Clubhouse. The other thing is if you'd like to come on stage, please raise your hand. You may have a question for Pierre, or you may have a story about your sale and your experience with your selling your company and how you handled that. Well, welcome from France. I presume you're in France today, Pierre?
Yes, I am actually.
Oh, very cool. So why don't we kick it off with the first question I have really is, timing. I want to talk about timing. Like, when is the right time to sell? And be interesting to hear from Michelle as well after you, Pierre.
Yeah, I'm very happy to start with that one. Like, great question. That's generally the main question that people ask is, should I sell now or should I sell later? So, in a perfect world, you want to try to sell when your business is basically booming, where you can go see buyers, show them like a strong growth, a path to profitability or an existing profitability, see that you still have a lot of potential on your market, because that's when you're going to attract as many potential buyers as possible. You're going to be able to negotiate harder and put them in competition. That being said, you also need to keep in mind that if your business is going well right now, you can be tempted of trying to sell to wait a year or two to have a higher level of revenue. But you also need to think that potentially the market can switch. So it's all about adjusting to where you think the market is going and trying to optimize for when you think you're going to be the most attractive and have the most potential, because you're really selling potential.
Yeah, and we had that situation last year with one of our e-commerce companies. We had two prospective buyers come knocking, and we're like, oh, we're just going to get, add another, whatever, $10 million in sales next year. And, the way we're going, everything's going great. So let's just wait and we'll get more value next year.
Yeah.
Meanwhile, if you've seen e-commerce companies in the stock market, they've fallen by 80 to 90%. We probably could have walked away with a pretty decent valuation last year. And today, if we were to go to market, not so decent. It'd be more of an earnings multiple versus a growth play. And that's interesting too, because we're in a new time now with high interest rates, potential recession looming, et cetera. It seems like the market is looking at profitability as being more important as a metric
Clearly.
than growth. Is that correct, Pierre?
100% correct. Now, most investors are looking at companies that can generate cash flow now, as opposed to trying to play the long-term game of trying to find companies that can 100 times based on their potentials. They really want to reduce their downside rather than looking at the potential upside.
So Pierre, I see, I'm looking, we know you're with Horizon Capital, and your
Yes.
specialties are mergers and acquisition, M&A. And I happened to notice that on your profile as well, that you said something about like micro SaaS companies. But could you kind of like tell us a little bit more about yourself and what kind of M&A opportunities or private equity opportunities you're looking for? I think that would be interesting to our members here as well.
Sure, happy to. So a little bit about my personal background. So right after my MBA, I started working in private equity, small cap private equity, and the small cap is important because small cap private equity is totally different from large cap. And then after that, I quickly moved to PwC, where I worked there for 5 years, first in France, then in Australia. So working on over 30 or 40 transactions, M&A transaction while I was there. And after that, I started working with Horizon Capital and my business partner, Akil, focusing solely on SaaS businesses. So for the past 3 years, 90% of the work we've been doing has been on SaaS businesses that are doing less than $5 million ARR, basically. And in terms of the specialty and the things I do is you're exactly correct. So I can either, and I've been helping entrepreneurs sell their companies as a M&A advisors or find companies to buy out to fuel their growth. But also I specialize in financial due diligence, which is basically the act of checking all the numbers and making sure you're able to write the story of a company or the historical trajectory of a company based on its financial statements and based on their numbers.
Excellent. So that sounds like a really fun job, actually, to me. But, so here's a question for you. What kind of things should a person, a company consider when they're looking at merging or being acquired? Like what kind of considerations? Like there's a lot of variation in between there. It could be a complete buyout, it could be a percentage, or as you said, maybe even a merger where you stay on. What would you advise people to consider when they're in this situation?
Yeah. So first, to link to the first question about when it's the right time to buy, I think a very important consideration as a founder is to look from a pure financial perspective, right? Is to look at what you would consider as a successful exit for you and what amount of money would be life changing for you, right? And everyone has a different number in mind. It could be 1 million, could be 5 million, could be 20 million. So if you ask yourself the question and you think that your business is at the right time to be able to attract that type of valuation and allow you to change your life, I think that's one of the first steps to take the leap and say, okay, I'm ready. I'm ready now, or now maybe a good time for me to look for buyers. The second step is what do you want with your company? So you have people who start companies just for financial gains, and they are very happy to sell it after 3 years. A lot of founders that I meet are like super passionate about what they created. They are driven by their mission, by their product, by their companies. They're basically the second baby, and it's very important for them to either have a legacy or at minimum to make sure that the products they build, that the organizations they build, that the people they work with are well taken care of after a merger or after a buyout. So basically, when you consider it, I think it's very important that you figure out what are your goals and what are the most important things for you. Do I want as much money as I can? Do I want to be able to continue working on my project, but potentially with more financial help from a bigger organization that's going to give me resources, that's going to be able to make me go to the next step of my growth? Do I want something where I just want to be an advisor or like a senior advisor, but I want to make sure that my name is still associated to it or that the brand I've built is still there. You start by answering all those questions. And once you have a clear understanding of what you really want, that's how you're going to look at the different opportunities that you can have and that you started mentioning. You can be bought out 100% by a strategic buyer. You can be bought out by a financial buyer who will generally want you to continue working for them. Possibilities are endless and are based on your own preferences. And if you have any more specific question, very happy to answer them.
Oh, it's interesting. You talk about different types of buyers. You
Yes.
mentioned strategic buyer, a financial buyer, which I call it really a cash flow buyer. It's similar, a lot of the private equity firms tend to be very cash flow oriented.
Mm,
And then you also have a competitor who can buy you out as well. And one of the things I often do is with our businesses, we have a number of them in the incubator, is really try to build and develop relationships with our competitors because one day they could buy us out. But can you
yes.
talk about which is the best? I mean, you've got this strategic buyer, cash flow buyer, and a competitive buyer, like a competitor buying your company. Which is the best type of buyer to sell to?
So I'm going to answer that question under the assumption that you mean what's the best buyer from a financial statement.
Yeah, to get the most
And
money, like who would pay
like
you the most money? Yeah,
exactly.
okay.
So, so generally speaking, it's going to be the strategic buyers, and the reason is very simple: is because compared to financial buyers, they are going to benefit from synergies. So, which means that for when they buy you, sorry, for every dollar of revenue that they buy from you, their things are be able to generate 1.5 or two additionals dollars, which means that from their perspective, your value is bigger than from a pure and strictly financial buyers who will look at your cash flow, kind of have a business plan of what type of growth you can get, and be limited in how much they can offer by your potential performance as a standalone. However, if I can add, you also have a like a third solution that may be very lucrative for, but maybe more for the top manager and not necessarily as much for the owner, is partnering with a LBO company, LBO private equity. So LBO private equity, we basically look at the cash flow generating company and buy them out using a lot of debt and then pay back the debt through the cash flow generated by the company. And the advantage of that, especially for the top management of the company, is the private equity will give back a percentage of their capital gain if they overperform, which is a very good way for top managers to generally make a lot of money without owning most of the equity.
Well, I presume that that would be a pretty difficult transaction today to happen given the interest rates. I mean, you'd
Uh,
probably be talking 12%, 13%
I mean,
interest.
to be fair, is I think we've just been too used to high interest to super low interest rate. Like when I talked to my father who bought his house like 25, 30 years ago, he's basically telling me he had to pay 15% interest on his mortgage. So and they were still buying houses. So I don't have exactly in mind how high the interest rate were 15 years ago, but 15 years ago you already had a lot of LBOs going on, even 20, 25 years ago. And I do think for LBO, like if you pay 12 to 15% interest rate on your debt for LBO, it doesn't seem that crazy to me. When I was back in MBA, that's kind of the interest we were using back in like 2010, eh, around that time.
No, I understand, and I think we've definitely been spoiled. That's possibility.
Mm,
I had the opportunity to acquire a company once. I had sold my company to a Fortune 500 company, and I worked at that company for 3 years. And during that time, we acquired a number of other companies. and I was in charge of the acquisitions. And
Nice.
the one company I'm thinking about, it was a pretty decent sized company. It was a $30 million deal when we acquired them, and they were a private equity firm that had a high leverage debt.
Mm.
And quite frankly, I nicknamed it a zombie company because all the people there would work all the employees would work all month long just to pay the interest payment.
Yeah,
And there didn't seem like there was a lot of motivation, a lot of vision. It was just all about pay that interest payment. So sometimes I don't know if maybe because of that experience, I'm partial against cash flow buyers. Obviously, if they're the only buyers, I think you obviously have to look at them. But cash flow is tends to be on the lowest of my lists. And then obviously competitors, they can get economies of scale,
mm,
and they'll generally pay you something more than your standalone value because they're getting that economies of scale. And a strategic buyer is going to leverage your business with their business in some way to give you a substantially higher value than your standalone value. They won't give you the full value that they benefit from because they want an
of
arbitrage, of
course.
course. But there's some midpoint between the two where they can actually give that to you. So I'm in agreement with you on that. With strategic buyers definitely being the top type of buyer if you can find one. Now let's flip it a little bit. Our business isn't doing that well. Assume for a minute our business is not doing well, and we're just tired and we just want to get out. What do we do at that point? What kind of deals do we structure? Um, one I know is call your competitor and say, "Hey, I'm done. Are you interested in buying?"
Mm.
And that's one technique. But I'm curious from your perspective.
That's a possibility, but you also need to keep in mind that generally when you're in that position, you lost most of your leverage anyway. So you're not going to get crazy multiples. You're just going to, if you manage to get an offer, you're going to get an offer from someone who was not necessarily looking to buy you out and understands you want to get out. So obviously, you need to ask yourself whether it's going to be sufficient for you and whether you could just continue or if it's the best decision for you at that point. But if you do that, you can also list your, depending on the size of your company, do have a couple of like broker website or website where you can list your companies to try to find a buyer. I'm thinking about Micro Acquire, which rebranded to acquire.com, for instance, who are mostly specialized in online businesses. But you also have other platforms like this that allows you to connect to potential buyers and at least get like a couple of offers to see how much you can get from it. Another path you could go down to is try to find what's called sorry, it's name. I'm sorry, I forgot the name. It's basically people who partner with financial buyers that are going to get paid for 2 years to find a company and become the CEO of that company. And
That's
so,
interesting. I haven't really thought or heard of those types of companies.
Yeah, I have a few friends that do that kind of thing. It's very interesting,
mm,
dynamic. But would that be called? Would you do that through a broker, Pierre?
for to find a company, you mean, or to get financed?
Like what you just said, where they put somebody in as the CEO for a few years.
So generally speaking, I mean, most of the time is either someone with a lot of industry expertise, like who has been a CEO of a company before, or someone who went through the path of getting his MBAs and working at McKinsey and BCG, and then had a couple of years as a high level senior team member in a good company, and get to a point where they want to be the CEO of their own company, but they don't have the cash to buy it out. So they partner with those exact type of investors who are looking for potential CEOs, and the CEO is going to be in charge of finding the company to buy out.
Right.
Search
I
founder
was
is the name.
actually at a company that was doing something like that, similar. Basically, it was actually the investors that put the person in,
Yeah,
in the CEO position, right? And then they actually were going to, obviously financially benefit from, I don't want to say turning it around, but actually finding a good buyer. So that's it's almost like a turnaround in many situations. But it's interesting that you bring that up, because that is a good opportunity for people to get a
mm,
CEO, and their mission, right, is to sell the business, and they'll get X amount of percentage, or whatever the compensation is, especially to the problem that Colin mentioned, right, where
mm.
you're burned out and you just kind of want to move on.
Exactly. And I think in most of these cases, the main difficulty is people don't want to trust someone with their equity, because most of the time, most of the equity and the wealth of the entrepreneur is tied to his business and to his equity. So taking a step to hire someone external to be the CEO and trust them with your company is basically trusting them with most of your wealth. And that's why they struggle to do it. However, I do agree that on paper, it's actually a very good way for you to not sell your company at a point where you're losing leverage, is to just step away from the business and let someone else run the day-to-day operations.
Yeah, another case study here. We had a company. It just was struggling, and it was about 5, 6 years, and it was an outdoor media taxi company. We had the taxi cab tops for Canada, for Toronto and Montreal, and we had exclusive. Like we had we almost had monopoly in some weird way, and we had been running it for years and years. And Uber was eating away at the cabs, and we just decided that we just didn't want to do it anymore. So what we did is we went to our competitor, or another outdoor media company. We got to know this gentleman for over a couple of years. And that's important too, is building the trust with the buyer, right? Because it's just handing it over to anybody. I mean, if you're going to shut it down anyway, you might as well gamble and hand it over. But the reality is, handing it over to anybody is not necessarily a good idea. But building and developing a trust with the potential buyer, I think, was important in this particular case. And what we did is we went to him and said, okay, we don't want to do this anymore. But what we'll do is we'll merge with you, and you pay us an earnout based on the actual revenue generated by our business. It's like something like 20% of the revenue for 5 years,
Mm.
and we will, and also we'll get 15% of the combined entity. And so we did that transaction. This was before the pandemic. And we did the transaction, and we are doing pretty well. We got about a third of our initial investment paid back, and then the pandemic hit, um, and and then it's slowly coming back a little bit here, uh, and we're likely to recoup our initial investment and potentially make a small profit on that particular deal. So if you're looking to buy companies, there are people out there who would be interested in selling them for their own cash flow. It is technically possible to do that, and the key is to develop a trust and relationship. Can you talk about that element of the deal, Pierre? Is this importance of developing trust with the buyer, or if you're selling a company to seller?
I think if you have the trust, it makes everything easier, because then you kind of need less due diligence. It's going to make the negotiation easier. People know what they're buying, they know their market, so even the conversation are going to be more fruitful because they're going to be on points that really matter. Uh, Not everyone can do that though. That's the reality. A lot of people, when comes the time where they want to sell their business, they have an idea of who could buy them out, but they have no previous relationship with these people. And and I think for anyone listening and who is in that situation where they're starting their company or they're currently running it and think they will sell in a couple of years, I think it's great advice to start trying to build relationship with some key players. You will never be able to know everyone that can buy you out, but if you can already have one or two guys in the loop that you personally know, I think it's going to greatly improve your capacity to make a deal.
Yeah, and I think the other example there was the recent one that Michelle and I did, and another gentleman, Jeffrey Sass. We sold a company to GoDaddy, and we had built it up over 10 years. And we started the first time we talked was about 3 years before we sold it, and then we talked again a year later, and then again a year later, and our numbers kept coming in. They kept seeing how well we were doing, and then they just one day decided to make the decision to do it and jump on it.
Look at it that way. Let's say you want to invest in the stock market. If you if you can pick any stock you want, you will still feel like you're gambling on that stock, right? If you've never heard of it right now, sure, you're going to do a bit of research, but you will still feel like you don't really know that stock, and you're taking a chance. Now, let's say that you pick a stock today and you keep track of it for 3 years. And then in 3 years, you make the decision to invest in it. You will have the feeling that you actually know that stock, that you've been tracking all these up and down, that you've been tracking, the information that impacted it. So you at least will personally have the feeling you know it. So that's exactly the same psychological process that will be happening in the head of your potential buyers. If you add several regular touch points, they will have a sense of familiarity with your product, with your company, that will make them way more confident in the possibility to buy you out.
Yeah, I just want to add something to that. Here's something that I've learned over the years. When you're young, or you're feeling whatever under pressure, you just want to try to make those connections as quickly and as fast as you can. And it's very difficult, right, to build a real relationship quickly or fast. What I've found in, especially in companies, like, it takes time. So go to the conferences, and even if your competitor is doing something particularly well, like, there's nothing like, compliment them on it. It's fine. But I think these are tend to be long games. And when I say long games, absolutely over a year, and it could take several years. But if you just keep the conversation open, and I've seen worked for companies where we were, publicly traded big companies, and we just kept the conversation ongoing with, our competitors that we were interested in either merging with or acquiring. And things do happen. And in our case, specifically recently with GoDaddy, we were probably their, best partner. And we just kept that conversation going and learned more and more about specifically what they were looking for. And over time, it looks like it magically happened, but these kind of things are often a long term in play, and especially if it's something that the acquiring company needs to fill out their product mix, or to give them a competitive edge, or even just to simply buy market share. It can happen as long as you kind of get in there and put in the time, and obviously you have to be providing value.
Exactly. Exactly. It's and like the more, I mean, the bigger you get, I think also as a owner and CEO, the more I feel like you're becoming a salesperson. Uh, like at the beginning, you do product development, you do strategy, you do execution, and so the more you grow, the more your role is going to be about building relationship with the right people and maintaining those relationship. And personally, I do think that the best relationships you can have are the one that you don't create out of necessity or out of greed, or because you have an interest in it. I think the one that you can really count on are the one where you clearly have an interest in the person. You like hanging out with them. You're interested in what they're doing, in having their opinion, and that's how naturally it will happen. And the reality is, I think that in any industry, in any line of work, in anything you do in life, you will always find people that obviously have common interests, but also with whom you click. You're not going to go to click with everyone. So don't spend too much time focusing on the one where it feels like it's forced, and just focus on the one where you have a real connection, where you know when you have a meeting with them, you're actually happy to talk to them, because they're the one that will also reciprocate or have a reciprocated feeling of knowing you and want to help you out.
And I would say they see the value, right, in the relationship. And as Colin said, going back to that, there's that mutual trust. Great advice, Pierre. So we have two people that have joined us on the stage. So welcome to the stage, Chris, and welcome to the stage, Chad. I know that's you, Chad. So, Chris, do you
Hey,
have? Hey, good. I'm doing great. Thank you. We'd
how
love
y'all?
to hear any experiences or any questions you have for our two experts here, Pierre and Colin.
Yeah, my name is Chris. I'm in the real estate space, also the wellness space. But I'm always I have friends that's always looking for good businesses with cash flow. I have y'all ever purchased any internet businesses? Anybody on the stage ever done anything with internet business that's got some good cash flow?
Um, we don't. I don't think we have any companies here that are for sale right now in the incubator. But I can tell you that the internet companies, the ones we have had in the past, have tended to do very well. Now, if you're looking for cash flow, you probably want to stay away from platform companies, subscription businesses. And then, because I'll tell you why, those are the types of businesses we love the most. We just sold one in December of this year. It was a platform company, and it was not profitable for its entire existence. In fact, it lost money right up to the day we sold it. But we sold it for 5.5 times revenue. And these companies are worth a lot because subscribers are worth a lot. They're actually one of the best type of businesses you can get are platform or subscription based digital platforms, similar to the one Club had. And of course, they have good value. Now, if you're looking just for cash flow, there are e-commerce companies out there, and they trade anywhere between 4 and 7 to 8 times earnings. Um, and that would be based on whether or not where the traffic comes from, and whether or not they actually have the customer base, or they purchase the traffic or whatever. So there's a lot of different parameters on that one. You have to be pretty careful with e-commerce, as we talked about earlier today. That whole area has just gone up and down, and pretty much crashed right now. So a lot of the e-commerce companies are struggling. But I think you bring up a good point. Is if you do have a good cash flow, there's always going to find a buyer. But if you're in a struggling business, it's going to be difficult to find that buyer. Any thoughts, Pierre?
Yeah, I guess one of the issue with internet companies that are cash flow generative is most of the time, it's not always the case, but a lot of the one I see that generate a lot of cash flow, they are not necessarily growing, because your profitability is going to be directly impacted by your growth, because in the SaaS business at least, what happens is you invest in your growth through your digital marketing mostly, so customer acquisition, which brings down your profits. So the quicker you grow, the less profitable you are, and you end up with SaaS companies and SaaS owners who have very profitable businesses that are not growing, they are fairly flat, but they're still expecting high EBITDA multiples because they're software companies. So especially I think if you come from the real estate investing, when you're more used to see the stream of cash flow and pay a certain multiple on that stream of cash flow, you may be a bit surprised by the expectation from the SaaS owners that are looking for very high multiple, even though their numbers, from my perspective, don't justify it.
Hey, I want to ask you another question. Have you all ever done with? What's your perspective on a apartment, multi units, or like a 50, 100 unit apartment complex? What's your perspective on that?
Uh, Sorry, you want to go, Colin?
Yeah, I'll give it a try. So we actually have a real estate business here as well in the incubator that we run, and it's about 19 properties, um, mostly single family homes, duplexes, and a triplex. But we actually operate them as vacation rentals. And as a vacation rental, we found that a particular formula works very well for us. But one thing I will say about this, and this is relevant for any type of acquisition. There are two ingredients for a successful acquisition. One of them is buy at the right price. That's when you make your money, when you buy, not necessarily when you sell. Obviously, selling, you feel like you made the money, but the reality is when you buy at the right price, that's where the magic happens, when you get a good deal. The second is leverage. And I'm coming back to this point, Pierre, because leverage today is very different than leverage was even a year ago. We were working on a loan a year ago at 5%, commercial loan at 5%. Today, we can't seem to find a bank that's willing to give us loans for real estate at less than 8% right now. It is absolutely, in my opinion, it's absolutely insane considering only 2 years ago or a year and a half, I got a loan at 3%, a 30-year fixed at 3% on one of the buildings. That was a personal building that I owned, wasn't a commercial loan. But the fact of the matter is, leverage is very difficult right now. If you have good cash flow, you're definitely going to be positioned better with the banks. If you're, are you in the United States, Chris?
Yes, yes, sir.
Yeah. So the one advantage, if you're an American citizen, you're in the United States, is that if it's more than, I believe, I mean, can think about this. I remember being, if it's more than a million or 2 million, I can't remember the exact cutoff. Then there are Freddie Mac or Fannie Mae backed government loans that you can get, where basically you go to the bank, they lend you the money, but they're backed by the government. So there is, for larger lenders, you can actually take advantage of that program. I do like the idea of, those large units. I just think right now we're in a very unusual time when it comes to leverage, and I think that's probably going to change in 2 or 3 years from now, and those numbers are going to come down. But if you're stuck with a long-term high interest rate, it's just going to be very hard to make the kind of returns you want to make if you're paying out 8% and your cap rate, you're only making 8%. I don't know if you've had different experience than me on this one, Chris. I'd like to hear from you.
No, everything you're saying is right on the money. The rates have a little thing to do with the return on your investment. You just got to be a little wise these days when you're doing things. With so much uncertainty in the market, nobody knows what the 2 or 3 year plan is. What's going to happen? I know. So I have some friends. They're putting down. Bringing more cash to the table on those multi units, and I don't even know if that's smart.
It seems like to be, one of the only game plans right now. Like when we were just doing a mortgage last night on one of the buildings, and it's co-ownership, Michelle and I with another partner, and we're like, okay, we don't. It's about 8%. We're going to be paying about 8% on it. It's a vacation rental in North Captiva, and it has very good return on investment. Don't get me wrong. We probably run around 12 to 14%, but we're like, we don't even want the full mortgage. We'll just take like half and just put more money up ourselves, just so we don't have to be stuck with such a high interest mortgage. And so you're right. There's definitely, if you have the cash available, it may make sense to put more money on the table than it is to leverage right now. But the key to good real estate is buy well, leverage well, and every business as well. Even if you were to buy an internet business, if you bought it well and you're able to leverage it, that can actually, that can help you out as well.
Yeah, I think you're making some very good point about that, because there's one thing I've been fighting against is everyone on social media basically saying, "Oh, buy real estate and you can never be wrong." Or if you manage to over leverage your real estate, it's going to pay for itself and you're going to become rich. Like it sounds like they've forgotten the basic rule of finance. Like they're assuming the price of real estate, of your real estate, whether it's a unit, a house, or whatever. They're basing their assumption on the fact that it's constantly going up, and they never really talk about the possibility of the house prices to go down, which may be dramatic if you or over leverage your investment, or if you didn't pay the right price at the moment where you bought it out.
Hey, there was an article. I don't know if you all back in 2008 in the Washington Post. It was talking about Trump and how Trump have changed his game, as far as the way he purchased real estate. Because he's been through a lot of the cycles. But it's in that article in 2008. Even if you Google it and read it, he's talking. They're talking about he was paying cash since 2008 up till today for properties. He's doing the same thing. He's bringing more cash to the table because I guess he's learned from the past, by being over leveraged from those times, that he went through. I think games changes a lot, and you have to change too with the game too if you want to stay afloat and be thriving. Thank you.
Yeah, and you have to think differently. And we've done a show here, about a year ago on tokenizing real estate. So it's an alternative method of funding your real estate where you actually sell coins. And I know crypto's got a bad reputation, but we're talking about fungible coins here, not non-fungible, where you actually get a unit, or you might get a unit in LLC. But the idea would be that you would raise money using Reg CF, crowdfunding regulation. You can raise up to $5 million, and you could sell these coins or these units, whether you use a coin or don't use a coin. This idea of actually selling them, and then people can actually trade them on exchanges and whatnot. So it's not like a timeshare per se, where you can't really sell them and you sort of own a particular 2 weeks of one particular unit. It's more like an actual ownership where you receive dividends and distributions and ultimately capital gains on that ownership, almost like owning a stock. And I think that's going to become more and more popular, especially in a higher interest rate environment. And so we have building lots, and we have a project where we want to build 3 vacation rental homes on North Captiva, and it's cost about $1 million a piece. And we've got the property already secured right across the street from the club. Really nice location. We'll build these beautiful vacation homes, but I don't want to go and borrow. A construction loan right now is around 11-12%. So we're thinking about the idea of doing a Reg CF and actually raising money from tourists on the island or through exchanges. And this is actually a good lead into our friend Chad right there, right? But this idea of tokenizing real estate, it is an alternative way of raising money in a higher interest rate environment. And I think we're going to see that rise in popularity. Chad, welcome to Startup Club and the Serial Entrepreneur Secrets Revealed podcast. This is actually a podcast as well, a live show on Clubhouse, and that syndicates into a podcast. And you can listen to over 92 episodes on your favorite podcast channel. Chad, what are your thoughts on this whole topic of exits? And maybe you can share some of the stuff I talked about on these tokenizations.
Yeah, well, thanks for having me. Hope everybody's having a good Friday. Well, I think from the title, as you know, like John Ferber and I merged the companies back in 2011 to form Domain Holdings Group, which is now still in existence, does $50 million a year as a company. I'm no longer involved. But I think and then another title was When to Sell, right? So we sold the brokers division to Flip and 99 Designs 5 or 6 years ago. And so my experience is once you kind of add VCs and you don't own, influence necessarily in the company, it's not really your decision to sell. You're part of a community or an organization you help build out, but you don't make the final decisions. And so um, my experiences, I think, is time. Um, if I can go back in time, would I do that again? Probably, maybe not. Now, can I get that time back of the tools that I need that I built back then that I need to go recoup now? So for my thing, I think now is I analyze everything in terms of time. So my value is my time now. So that's kind of from the header of your title. Now, in terms of tokenizing real estate, I do run a company called Realty DAO. And we were tokenizing real estate about 5 years ago, but we saw the amount of work that goes into the analog in real estate still early from a risk reward situation. And I think what you're talking about is you're tokenizing the cap table of an LLC, and then you're tokenizing that, which owns the property, which companies like Property are doing, and a bunch of other companies are doing now. So that is the future. That is the better mechanism to create liquidity for your property. My opinion.
Oh, that's interesting. And so, have you seen these? I mean, have these deals dried up? These tokenized real estate deals, or are you seeing any action in that? I know it's pretty nascent, the whole concept.
Yeah, it's getting loaded up. I mean, you have DAI. DAI is a pretty big stable coin. I think they're like 6 or 7 billion, and they've diversified their treasury with like some commercial, real estate bonds. And so some of these stable coins are starting to asset back their one-to-one stable coin with other assets, and you can't do that technically with a stable coin unless it's digitized. And so, but DAI is an example of one that has like a certain percentage of their treasury with commercial real estate paper. So it's gearing up. I mean, it's just a better way. It's everything's better. It's just people start being cautious and they're trying to make sure they do it right. But the floodgates are already open because it creates. People need 10% liquidity, 20% liquidity on their portfolio. That's one of the best ways to do it. So it is the future. I don't know how fast it's coming, but it's coming here. I mean,
Excellent.
just in the last year, Colin, a lot of the people are in Florida. Properties in Florida. Um, Lofty is in Florida. I mean, there's at least 10 companies coming out of Florida that are tokenizing. A company in Boca here. Um, they're going after residential properties like yourself. And there's one guy in Boca has like, I think they're up to 100 properties. And then most of their customer base is foreign buyers. And they pay a dividend they used to do a dividend every day. And then Ethereum gas prices got too expensive and stuff like that. But I mean, they're paying residuals every day from a mechanism. And you can't do that with fiat um, analog equity shares.
Yeah, we don't want to go off topic, but I guess one of the advantages we thought about for vacation rentals is that they become your customers as well, and they get VIP access to your booking and discounts on booking, and they become actively engaged, and it's a way sort of engaging a customer base as well. But I'm going to ask, Pierre, you and everyone on stage this question: is that do we all always need to sell all of our company? Is there a model where you can sell a part of your company so Pierre, you can meet the needs you talked about earlier? You have a need for X amount of cash. Maybe it's to buy a home, to put your kids through college, whatever it is. You meet that need, and you sell 20% of your company, and hold the other 80%, and maybe sell it off a bit at a time. Any thoughts on that one, Pierre?
Yeah, and, I think everything is possible as long as one, you find a buyer. Even though basically, if you're trying to get 20% off of the value of your company, you can actually do a LBO on your own company. So raising debt, replacing part of the capital by debt, cashing it out, and then using your cash flow to pay back the debt. That's also one possibility. It all comes down to how much involvement you want in the company and how much involvement people that buy you out want you to have in the company. Because sometimes you're too tied to the company that investors make it contingent for you to continue running the show to be able to cash you out. Some other times, if you manage to get to a point where you build a company that is self-running and you can step away from the business, then happy days. There is also a scenario in which, like a business model of instead of trying to sell your whole company, you can keep your company and you use the cash flow to start off your next company. And if you look at business model like so in the software world, they're very famous. It's Constellation. They started with, I think, like something like 15 or 20 million 30 years ago, started buying software company. And with the cash flow of their acquisition, they would finance their new acquisition and grow their portfolio of company that they hold forever. And now they're a multi-million, even billion-dollar group that have heaps of companies that just generate cash and continue their strategy of acquisition.
Yeah, I think that's amazing, right? If you can find a company that fits that scenario where it can fund more your business and more acquisitions with their cash. And I agree with you. The best acquisitions and or mergers that I've personally been involved with are ones that are very clear from the front what the structure in terms of the management is going to look like. And I always found that it is good to have that all very laid out, very very well before even the transaction closes, and then you can just smoothly glide into, if there's such a thing, um, you know smooth operations, which is what you want. You don't want like all this disruption, right? Because the last thing you want to happen when somebody's acquiring you or you're merging is to have a disruption in your income stream.
Yeah. I do think that's basically a talent, and maybe we don't flag that often enough. That some people are great leaders, they're going to be great CEOs to lead a company to success, but a lot of the company rely on them. And there is a few people who have the talent to be able to build great organization that don't need them at the end. They just put together all the pieces and is going to be self-sufficient, which allow them to just step away and just have a strategic role, high-level role where they give their input once a month, and the company is doing well without them.
Yeah, absolutely. And again, like I said, in my experience, I love it like when you can get together with a competitor or someone who's really just looking for a very specific skill set.
I think one of the keys we have to watch out for in these partial sales is control. There have been a lot of horror stories of companies that have sold and lost control, but of that, we traded company to another company, but our shell
Yeah, Colin, we're losing you.
relation. Sorry, I got some background noise here. Ah, hold on.
But yeah, what Colin was saying,
Yeah,
and
sorry about that.
okay, he's back.
Sorry about that. Yeah, I just I lost my headphones and then a lot of I'm
No
outside
worries.
here. But we sold a company. It was a publicly traded, had a phenomenal, astronomical valuation. It was just before the dot-com crash, and we sold it for. It was a merger. It was $180 million, and subsequent to that sale, it went over $1 billion. But yet we were locked up, and we did not have control of the company, and because of that, a lot of decisions were being made by the different people who were running it, and ultimately, those shares that were $18 a share went to 6 cents a share by the time we could actually trade them. And we spent 10 years building this company and 1 year screwing it up. And I sometimes think that entrepreneurs, we do that. We'll spend a lot of time thinking about how to build it, a lot of energy put into that. And when it comes to selling, we spend so little amount of time. When if you can plan it correctly, you can think it through, you can obtain liquidity or keep your control, then you're in a much better job in selling the company. Any thoughts, Pierre, on that scenario?
Yeah, it's quite unfortunate that that happened to you, but that's also fairly common, and not only with partial sale, it also happens with earnout. You know, when you're tied to the performance of the company within the next few years, then you need to make sure that you decide, and it's very clear with your buyers who's going to be responsible for what and what type of control you retain in the company. Like I was working on a deal few weeks ago where the guy had created an app, and because there was a lot of potential, but as of right now the business was not generating that much cash and still needed a lot of work, we would have um, created a transaction and structured a transaction with a 3-year earnout based on the performance, basically. But he was totally happy with that. He is actually the one who came up with the idea. However, the one thing he didn't want to even negotiate on was he wanted to retain control over the design of the product because he knew the market. He was happy to trust us for growing the company from a digital marketing standpoint and for external acquisition standpoint. But the product, because he was the expert, he wanted to be to make sure that we would not be able to make the final decision on what the product should look like. And I think that's totally understandable, and that's something you should definitely keep in mind if you're in the process of selling part or all of your company. Is if you stay involved or if your payout is tied in any way, in any form, to the performance of the company, how do you make sure that you have some sort of control and some sort of impact on the performance of the company going forward? And one way to do that I've seen, for instance, even if you want to give up control, then I think at minimum you should have some structuring and some wording in the legal agreement that says that if the company starts underperforming, then the clause kicks in and you can take back control of the company to bring it back to where it was before.
Yeah, we didn't have that with our last contract, and I'm not really able to speak to it. But I will say that we had clauses in there that if they performed a certain way, then we would still get paid our performance bonus. Um, Mostly transactions that I've worked on, generally they'll hold back about 10% for escrow. In this particular transaction, we also were um, uh, making an earnout as well on top of the sale price. And so, what we did learn through that process was that we really had to spend the time with the lawyers to define every single element of the earnout because there's a lot of ambiguity in language. And when you sign these contracts, when it comes to paying out thousands, tens of thousands, even millions of dollars on an earnout, the nuances of one tiny word can have huge repercussions. So I definitely would recommend spending a lot of time with your lawyer to ensure that you've got the right language if you do have an earnout structured as part of your agreement. But what
Yeah.
is typical, Pierre, for companies is for an escrow? I know escrow is different than earnout, but what would be a typical escrow?
Um, to be fair, escrow, I don't find it as popular or as usual as earnout, for instance. Uh, like of course, it's not unusual either. But a lot of deals I've worked on didn't even have an escrow account. But I think that's because you have other ways to reach the same type of structure of output without necessarily using an escrow account. Because the main issue like people have with escrow accounts is basically if you put part of that money on an escrow account, the main people who benefit from it are the banks getting the interest on it. It's just money you don't give to the seller, so they can't really make anything out of it, and it's also out of your own pocket. So it's kind of a situation where both parties are kind of are kind of losing and not earning any interest or any return on investment on their money. Of course, in certain situations, like escrow account can be super useful to build trust, and I think we come back to the trust factors that we're talking about at the beginning. It's mostly applicable when you're not sure whether the company or like the buyer is going to have the fund to pay you out in the future. But if you're in a scenario where the strategic like is a huge company and they clearly have like a huge balance sheet, or a financial buyer who clearly has a lot of dry powder, then the escrow account is not as useful from my opinion. However, in terms of earnout, what I would say is fairly common is to have anything from like 10 to 30% of the price as an earnout. But in some cases, and companies like Constellation Software are known to have like a huge amount of the purchase price paid as an earnout, like can go up to 60 to up to 70% of the purchase price paid over time based on performance.
Yeah, I think the buyer likes to pay over time, but the seller likes to get it up front. Well, Pierre, this has been really good. How do people reach out to you, and how do you pronounce your last name? Ubutrus?
Yeah. Always an issue with non-French speakers. So my last name is Heurtebize,
Heurtebize.
which I acknowledge is a bit hard to pronounce for non-French speaker. Actually, the best way to reach out is either on my LinkedIn, so Pierre-Alexandre Heurtebize, or they can reach me to my email, which is Pierre at Horizon, HORIZEN, capital.com.
Well, I can't thank you enough. We always learn so much when you come on the show. This is the second time you've been on, and we really appreciate you coming on. Thank you very much. And for everyone listening here, I think we had a real treat. I think I might even have to go back and listen to it again to really pick up all the details that we went through. But thank you very much again. And we will see everybody next week, 2 o'clock Eastern, on the Serial Entrepreneur Secrets Revealed. It's a podcast as well, a live show on Clubhouse. So if you're only listening to it in podcast, did you know you can actually come live onto the show, like Chris and Chad did here as well today, and come on stage and ask questions and interact? We love that. Thank you very much, and we'll see you next week.
Thanks, Colin. Always love the invitation.
Thank you.
Bye bye.
Thank you.